Okay, once more. Hi guys. So we are looking at the accounting dates and basis of assessment. We moved from commencement date. What happens when we have a business just starting? Today we are going to look at what happens when the business ceases to operate. So we're looking at cessation of business applicable rules. Are we together? Okay. Hope you are following. A number of points need to be looked at in this regard for tax purposes. One, you should note that if the last accounting period is exactly 12 months, then normal rules apply. When I say normal rules, I mean where you look at the accounting period, the accounting date, and find out if it is falling between 1st January to 31st March, then you know you have to use the preceding year basis. If it falls between 1st April to 31st December, then you know you are going to use the current year basis. Those are the normal rules. So this point is trying to emphasize that fact. If the last accounting period is exactly 12 months, then normal rules apply. Second point to note is that if the last accounting period is less than 12 months, then the profit for that account period are assessed in the tax year following the one in which the profits of last accounting period were assessed. Okay, so that's what we should know. Then the third point, which we are going to actually see when we look at the example, the third point is if the last accounting period is made up of more than 12 months, then the period should be split like before into a 12-month period ending on the normal accounting date and the short period ending on the date of cessation. Okay, so when you look at this particular point, you note that there's a difference in approach from when we were looking at it from the standpoint of commencement of a business. For commencement of the business, where we had a period of more than 12 months, of course we had to split between two notional periods. The first period was a period less than 12 months. The last period was supposed to be exactly 12 months. Now, in this particular case, when it comes to cessation of business, what you should know is that the short period is the last period. And the first period, in this case, will be exactly 12 months. So that's what this point is talking about. The next point to note is that profit of long accounting period should be allocated to the two notional accounting periods on a time basis. This is just as what as before when I told you that once you have split the accounting period into two notional periods, equally the profits for that particular charge year needs to be apportioned to the two notional periods on the time basis, and I did demonstrate how that is done. Next point is looking at the tax year in which the profits of the 12 months period are to be assessed is determined by using the normal rules. And then the profits of the last account period, which is the shorter one, the one with the last 12 months, are to be assessed in the following tax year. So those are the important points to note when you are dealing with cessation of business applicable rules. So let's look at an example and see how this is applied. Example 1. We are looking at Mr. Daka has been in business for many years, ceased to trade on 30 September 2021. The tax adjusted trading result produced by Mr. Daka has been as follows. So we have these three periods, each of the first two of 12 months, so which is year ended 31st December 2019 with an amount of 89,500 as profit. We also have year ended 31st December 2020 accompanied with an amount of 94,000 kwacha. The third period is less than 12 months. We have period ended 30 September 2021 and the amount is 74,000. So what is the task before us? We are supposed to show the income tax assessments for all the relevant tax years, identifying the basis period. So this is very critical. So let's look at a number of points that we need to consider springing out of this particular situation. So in looking at this solution, these are a number of points that need to be considered or taken. One is that accounting date falling between 1st April and 31st December, hence this is a current year basis. So that's the first thing you can easily note from the previous year's presentation, where we went through the normal rules relating to determining whether it's a preceding year basis or current year basis. That should be quite familiar with you now. The next point to note relating to this situation is the last accounting period consists of less than 12 months. So we have just mentioned about the rule relating to an accounting date accounting period which is less than 12 months. We are going to see how that is applied in this particular example. The third point is to determine which tax year this period is a basis period for. The current year basis or the preceding year basis, as the case may be, or does not apply in this particular case. Okay, so the last period of trading is a basis period for the tax year following the tax year, where the basis period is the year ended 31st December 2020. Okay, so that's what we look at. So now, following from these observations, how do we go about working on this particular task? So that's the next thing I want to demonstrate to you. So we look at that. As before, you need to look at the heading. In this particular, the income tax assessment on previous year basis. Okay, this is supposed to be current year basis, not previous year basis. We look at this particular adjustment here, current year basis. Okay, so now we also need to realize that when you are making a presentation relating to income tax assessment, you need to bring out 3 columns in the name of tax year, basis period, and the profit, the income being assessed or the income involved. Okay, the tax year is the year in which the tax is assessed. The basis period is the period in which the income to be assessed is generated. Okay, so that's what we need to remember. I did emphasize this even during the previous presentation for accounting dates and basis of assessment part 1. So there we are. We have in this particular case, let's look at the example. We have this particular case, year ended 31st December 2019. As long as the period is between 1st April to 31st December, then you use the current year basis. So the first period and the second one will use the current year basis. Why? Because even the third one, because we have these accounting dates falling between 1st April and 31st December. So that's why you will notice here. So mean that the year in which the income was generated is the year in which the income is taxed. So that's what it means here. So we have basis period year ended 31st December 2019, tax year 2019 as well, and the amount is 89,500. Okay, Then we also have the next one. We're looking at year ended 31st December 2020 with 94,000. Again, it's a current year basis, so meaning that the same year in which the income is generated is the year in which the tax is assessed. Okay, based on the income generated for this particular period, the basis period, 94,000. That's what you are seeing there. Okay, so now the next one is 2021. This is a period of how many months? This is a period of, if you look at this question, this is a period of 9 months. This is a period of 9 months. So now, when you look at the rule, okay, let me just draw you back to the rule. You see that the tax year in which the profits of 12 months period are assessed, the profits of the last accounting period, the one with less than 12 months, are to be assessed in the following tax year. In the following tax year. Following to what? To the previous one. Okay? So now when you look at this one, okay, the previous tax year was 2020. So the following tax year is 2021. So that's what we are going to follow. Okay? So we have tax year 2021 following 2020. Okay? That is 74,000. So that is what we do when we are compliant with the rules relating to cessation of business. So that's how we approach this particular part of the question. So we look at the next example just to emphasize this. Next example, that example 2. Example 2 has to do with Mr. Masando. Masando has been in business which ceased to trade on 30th June 2019. The last accounts were prepared for a period of 15 months ended 30th June 2019. The tax adjusted trading result produced by Mr. Sando have been as follows. Again, just like before, the thing to note is that there is a period involving more than 12 months, the 15 month period, where we require to split the period into 2 notional periods. Okay, we split the period into notional periods. So we are being told the last accounts were prepared for the period of 15 months. So this Mr. Masando was ceasing to trade. The last accounts were prepared for a period of 15 months. So we are using cessation rules, cessation of business rules. The last accounts were prepared for a period of 15 months. Means that we have to split them into 2. How? The last account, which we are going to look at, the first account will have exactly 12 months. The last account will have the balance of the months. Okay, so which is different from the commencement, where the first account is less than 12 months. The last account is exactly 12 months. So you need to take note of this, and whenever you are looking at the cessation of business, and also when you are looking at commencement of business, where there are more than 12 months involved in the period. Okay, so just like before, I wish to start by looking at what are the important points you need to note about this. Okay, so looking at the period involved, you are talking about the year ended 31st March, and you have 31st March, again 31st March. Now when we split this, we are going to see what it's going to give us as well. But for the 31st March year end, that is signaling to us that you are supposed to use the preceding year basis. Okay, so that's what you should consider. Okay, That's accounting period exceeds 12 months, as I've already mentioned. It should be split into two notional periods. One period of 12 months ending on the normal accounting date of 31st March, okay, and the period ending on the date of cessation, okay. So that's what is supposed to happen. So the last period profit will be assessed in the tax year following that, whose basis period is the year ended 31st March 2018. Okay, so that is what we're going to look at. Let's look at how I present this particular solution. Okay, so this is just demonstrating how you split. By now you should be familiar with how we split these this profit to two notional periods. The first one, 12 out of 15 times the total of 74,000, giving us 59,600. Giving us 59,600 is what we get there. Then the other period, which is running from 1st April all the way to 30th June, that is 3 months. That is 3 over 15 times 4,500 will give you 14,900. Okay, 14,900. So that is just to make you reflect on how we split the profit into two notional periods. Okay, so that's what we have. Then we proceed in this particular case. What do we see? What we see in this case is that we have the first one, which is 48,900, which will be assessed when? In 2016, since the preceding year basis. The 58,700, this one will be assessed in 2017, since it's preceding year basis. Okay, the next one, which is again ending on 31st March 2019, it will be assessing the tax year ending 2018, since the preceding year basis. Okay, so now that brings us to the other rule, which I talked about. Okay, so looking at that, okay, we have that. Okay, so we look at that. These are what we have split. So 2017, there's 48,000, so this is preceding year basis. 31st March 2018, 58,000, this is preceding year basis. So this 48, as I've said, it will be assessed in the tax year 2016. This 58 will be assessed in the tax year 2017. This 59 will be assessed in the tax year 2018. Okay, 2018. Then the last one is assessed in the tax year following the previous assessment tax year, so which is going to be 2019. Since 59,000 using preceding year basis will be assessed in 2018, the last one will be assessed in 2019. Okay, so let's look at how that is going to be presented. So you have this. So the tax year 2016, as I've said, the preceding year basis 48,900, and the basis period means that in which period was this income generated? In the year ended 31st March 2017. That's the basis period, but it is assessed in 2016, since the preceding year basis. And the next one, the year ended 31st March 2018. The preceding year basis is the accounting date is falling between 1st April to 1st January to 31st March, so it will be assessed in 2017, but it was generated in the year ended 31st March 2018, 58,700. Then the year ended 31st March 2019, again is the preceding year basis, means that you are going to assess it in the 2018, this amount of 59,600. Then this period ended 1st June 2019. Since it's the cessation, the rule is that this amount is supposed to be assessed in the tax year following the previous tax year of assessment. The previous tax year involving this one, which is 2018. Following 2018 is 2019. That's why you have 2019 here. That's where this one will be assessed. So that's how we answer such type of a question. Okay. Then we also have the other important aspect to look at is the next one, which is change of accounting date. Change of accounting date. So important. Okay. In the change of accounting date, we need to learn. We need to share maybe some of the reasons that lead to change of accounting dates. The reasons to change accounting dates can be as follows. One, it can be due to administrative simplicity. Administrative simplicity. You know, sometimes when you look at businesses, okay, in certain in the financial year, you might find that certain periods of that financial year are much more, or the company employees are very busy, or the activities are at peak. Okay, so now you find that when it comes to closing of accounts, okay, closing accounts, they will rather maybe close accounts properly when the organization is off peak, so that they attend to all those procedures and processes that are required as you close the accounts. So the organization might think of shifting from the current accounting date to the one which is favorable for them in terms of administrative simplicity. So that could be one reason why an accounting date changes. The other one is for commercial reasons. Okay, almost in similar manner to the first point I've talked about. Sometimes you find that when it comes to accounting dates, there could be activities like stock taking and so on and so forth. When you are doing stock taking, you might find that it might take a bit of time to count your stock and so on and so forth. And it might take your valuable time from employees looking at those particular activities. And if at all that is the time when the business is at peak, you might end up losing revenue or income. So for commercial reasons, you might think of changing accounting date so that you don't miss out on encashing on those peak periods, if that is causing you to lose revenue. So that could be the reason why there can be a change of accounting dates. The other one could be due to regulation. Again, as an entity, you are supposed to be a corporate citizen of a particular jurisdiction. So you are supposed to be compliant with the laws and rules of that particular country or state. You might find that the state might just wake up and change certain regulations or force you to comply, and you have no option but to comply. So sometimes the change of accounting dates could be as a result of regulation change. So regulation has changed, requiring you that you're supposed to be reporting as over a certain particular period, or the accounting date should be of a particular date, so as regulated by that particular authority. So that could be a trigger for change of accounting dates. Lastly, I thought of talking about groups. Okay, sometimes you have an entity which is part of the group of companies. Okay, so you are a subsidiary. Okay, now when you have a subsidiary, you find that you need to have, or you definitely will be aligned to what the parent company is dictating. For reporting purposes, companies in a group structure would like to be reporting, to have the reporting date which is the same. That facilitates easy reporting. So if you are just been maybe acquired the company, or you have just joined this particular group, you might be forced to change the accounting date to fall in line with what the parent company wants you to do in terms of reporting date. So that could be the trigger for change of accounting date. Okay. Okay. So when there is change of account date, what type of rules are we supposed to be following? So I've indicated determining the basis period rules. Okay. In this particular case, a number of points have to be taken note of. One is that in the tax year in which the change occurs, the normal basis of assessment, either current year basis or preceding year basis, applies. Okay? So in the tax year in which the change occurs, the normal rules apply in short. In the tax year in which the change occurs, again, the basis period should end on the new accounting date. Okay? Apart from the normal rules applying, you should not focus on the fact that the basis period should end on the new accounting date. Thirdly, take note that at least 12 months worth of profits are charged to income tax in the tax year when the change occurs. Again, we can be confronted with a situation where you have less than 12 months period. What do we do in this particular case? Where you have less than 12 months worth of profits or period, the profit of that period is scaled upwards to correspond to a profit figure that would arise for a 12-month period. Okay? So what does it mean? Let's suppose you have an accounting period of 9 months. An accounting period of 9 months with a specified amount of profit generated. So what you do in this particular case, you have to gross it up to come up with a profit which would have been realized had you run for 12-month period. That's what it means by scaling upwards to correspond to a profit figure that would arise for 12-month period. The scaled up amount is a profit chargeable to the income tax in that tax year. Okay? So the scaled up amount is the one which is going to be chargeable to income tax in that tax year. Another important point is to take note that if two accounting periods end in the same tax year, the amount of profit chargeable to income tax in that tax year is the sum of the profit for the two periods. Okay, so I'm going to demonstrate how these particular rules apply using an example. Let's look at example 1. Example 1. So here we have Salati. Let me just pull it down so that it can look bigger for you to see properly. Okay. Okay. I believe this is big enough to be seen clearly. Okay, so we are saying Salati has been in business for many years, preparing accounts to 31st December. After preparing accounts for the financial year ended 31st December 2020, he changed the accounting date to 30 September and prepared the next accounts for the period of 9 months ended 30 September 2021. His tax adjusted profit for the relevant account period as follows. Okay. What are we required to do? To show the income tax assessment for the tax year 2019, 2020, 2021 and 2022. Okay, so now What do we note in this particular case? All these periods accounting dates are falling between 1st April to 31st December. So meaning that we have to use the ordinarily the normal rules will apply, which is the current year basis. Okay, current year basis. That's what we are supposed to use. Then we notice that the last accounting period is less than 12 months. Less than 12 months in this particular case. Okay, so if this is the end of the business, means that we have to scale up. Okay, we have to scale up to reflect an amount which would have been realized if the 12 months period was the one to generate the profit. How much would have the 12 months period generated in terms of profit? Meaning that the assumption which is made there is that the profits are earned evenly throughout the accounting period. The profits are earned evenly throughout the accounting period. So what is it that we need to note under this particular circumstance? Further to what I've just said. Just to emphasize, I'm saying Salati prepares accounts to the 1st December. So what does this mean? This days falls between 1st April to the 1st December. So the basis of assessment has been current year basis. Then the change occurs after 31st December 2020. Okay, that's what we are told. The year ended 2020 becomes the basis period for 2020 tax year. The basis period for 2021 tax year ends on a new accounting date, which is 30 September 2021. Okay, now this is 9 months. So that's why I was saying profits will cover a 9-month period ended 31st September 2021. The requirement is that at least 12 months period profits must be assessed when accounting dates change. When accounting dates change, the amount of chargeable will be scaled upwards to be for 12 months. I've already belabored on this point, just trying to emphasize what this particular situation is throwing in our path. So let's continue and see what happens in this particular case. Okay, so we are looking at how do we scale up the profits. How do we scale up the profit? Remember, the profit which needs to be scaled up is this particular one. The period end 31st September 2021. The figure is 63. This is a 9-month period. So it has to be scaled up, stretched to 12-month period profit assessment. So that's what we are going to look at. Okay, so what do? We get, if I may show you, you can do this. What this one is trying to tell us. Let me just show you what this one is trying to tell us. Okay, so you are saying the figure is what? The figure is 63,600. 63,600. So I have 63,600. Okay, so 63,600 is equivalent to 9 months. 9 months. Okay, 9 months. Okay, it's the 3,600 kwacha, 9 months. So what we are worried about is what figure should we look for that has to do with 12 months. Basically, that's what we're looking at. So what we do in this case, we cross multiply and solve for x. We cross multiply and solve for x, meaning that x in this particular regard will be equal to 63,000. You cross multiply, that's 63,600, and then you multiply by 12 months. Okay, 12 months. That's what you do. Then you divide by 9 months. So you divide this one by 9 months. Basically, that's what you are doing. Divide by 9 months. Let's move this one. 9 months. Okay, so that's what you do. So when you sort out that one, you are going to end up with a figure that is going to be as calculated here, 84,800. This one, that's why you have this fraction, 63,000 times 12 over 9, which has 84,800. So that's what I was trying to demonstrate for you, so that you have this one. So that is 84,000. Is it 800? Okay, something like that. 84,800. Yes, 84,800. So that's how this is brought about. So that's what it shows here, scaling up. So we have scaled up from 63,600 to 84,800. So what does that mean? Okay, the implication that there will be an overlap profit. Overlap profit. Okay, there will be an overlap profit. This is chargeable profit minus actual profit. Chargeable profit minus actual profit. The actual profit is 33,600. There is an overlap of 21,200. Okay. Now, what you should know in tax is that this overlap profit is supposed to be set off against the assessment for the final year of trading. Okay. And then also the overlap relief ensures that the amount of profit chargeable to income tax throughout the year of the trade is the actual taxable profit. So what does this mean? Okay, when you look at this overlap profit, okay, in the final year of trading, when you cease trading, okay, this record is kept for overlap profit of 21,000. This record is kept so that in the final year of trading, okay, you are going to look at the profit gain in that year, reduce 21,000, because there is this notion of profit that has been taxed, which was not supposed to be there. So you come to get the relief in the very final year of trading. That's when you subtract it from the profit generated in that final year. So that balances off or squares off the imbalance. Okay, so that's why there is an overlap relief that ensures the amount of profit chargeable to the income tax throughout the life of the trade is the actual taxable profit made. That's the idea. Okay, so that's what we have. Any queries relating to that? Okay, we are proceeding as required. So how do we go about now doing the income tax assessment? After working out these particular figures, we arrive at this income tax assessment for Mr. Salat. So as before, you need to always remember that you look at the tax year column and the basis period and the profit. Okay. Since year ended 31st December 2019, this is the current year basis, means that the same year in which the profit is generated is the year in which the tax will be assessed, 2019. The figure is 55,400. In the following, we have the year ended 1st December 2020. Again, is the current year basis. Why? Because the counting date is 31st December 2020. 31st December. So, it means that this profit we generate in this period is assessed in the year itself of assessment, which is with the year of generation, which is 2020 tax year. Then we come to 2021. Period year ended 1st September 2021, okay, but it has been scaled up to 84,000, okay. So when you look at this one, this is the current year basis, so 2021 is the current year, so that is the tax year as well. Then the next one falls in smoothly. You have year end 30 June 2022, and this is 30th June, that is still between April and 31st December, so current year basis 2022. Okay, now when you look at this, okay, this year of up to 30th June 2022 covers also the 21,000 which has been stretched from 2021. That's why we talked about overlap of profit. It overlaps into 2022. So it's like taxing 2020 the amount twice. Okay, so that's what we have here. Okay, so that's why there is the taxpayer who is entitled to claim relief at the cessation of the trade, where this one is set off against the income in the final year of trading. So that's what we have here. Whatever belabored that point, so I just thought of trying to make an emphasis on this particular case. Okay, so now that's what we have. We also have example 2, just to emphasize this one. Okay, in this example 2, we have in this particular case Dumbwiza. We have Dumbwiza. Dumbwiza has been in business for many years, preparing accounts to 30 September. After preparing accounts for the financial year ended 30 September 2021, he changed the accounting date to 31st December and prepared the next accounts for the period of 3 months ended 31st December 2021. His tax adjusted profit for the relevant account period are as follows. So we just going to look at this one. Okay, that's how it is. So we have these accounting periods. We have year ended 31st December 2019. Okay, immediately we look at that, the accounting date is falling between 1st April to 31st December. It means that we use current year basis. Okay, then you have year ended 1st September 2020, again current year basis. Period end 31st December 2021, current year basis. Okay, now this period is there's a change of accounting date here. Okay, which continues to 31st December 2022. So we have a change of accounting date here. So what does this mean? If you count from 31st September, you have October and November as well as December. So meaning that this period, which stretches to 31st December, is going to account for 15 months So we have a period of more than 12 months. So we're going to see how we are going to treat that. That's the essence of this particular example. Then what are we required to do? Show the income tax assessment for the tax year 2020, 2021, and 2022. So again, I like putting notes so that it helps you to remember what you're supposed to be done here. Let me just extend this one so that you can see properly. Okay. Okay. That helps you to look at the question better. Okay, fine. So we are supposed to show income tax assessment for the tax year 2020, 2021, and 2022. So that's what we are supposed to do in this particular. So what points do you note from this? Okay, assessment, as I've said, is current year basis. Why? Because the accounting dates are falling between 1st April and 31st December. Now, following change of accounting dates, still there is current year basis, because again the accounting dates are falling between 1st April to 31st December. Basis of assessment. Basis of assessment for 2021 has two accounting dates: year ended 30 September 2021 and 3 months ended 31st December 2021. Okay, so that's what we have. We also have that makes the 15 months I was talking about. Then the profit assessed in 2021 should be equal to profit for the year ended 30 September 2021 plus 3 months ended 31st December 2021. So how do we determine this assessable profit? How do we determine this assessable profit? Look at that. Okay. So profit for year ended 30 September 2021, we have 76,500 plus 66,300. Okay. So let me just show you. Okay. From the example, 76,500 plus 66,300. Okay, that's what we have, meaning that we have a total of 142,800. Okay. No overall profit, as no profit has been charged more than once. Okay, so add this. So then we go on, once we have established that one, we go on to look at the assessment table. Okay. Okay. Again, tax assessment for Mr. Dumbwiza. We have tax year, the basis period, and profit involved. Okay. So now when we look at this, we have 2020 year end 31st September 2020, 56,000. Look at the example. Yeah, so 56,000. This one. Then next we look at this which crosses two periods. Okay, so we add the two. 76,500 and 66,300. What you get to is 142,800. So we have in this particular 142,800. Then we have year end 31st December 2022, which falls squarely into 2022. That is 79,900. So that is in compliance with the rule which we have looked at. Just to emphasize, let's get back. Let me just emphasize. Okay. So if two accounting periods end in the same tax year, the amount of profit chargeable to income tax in that tax year is the sum of the profit for the two periods. So this is the note that is being applied in this particular case. Okay, so that's what we saw in that particular example, where we ended up with 142,800 to come up with this assessment here. Okay, what other notes need to be considered? Okay, just to emphasize again, if accounts period is greater than 12 months ending the tax year when the change in the accounting date occurs, the profit for that period is the amount chargeable to income tax in the tax year when the change occurs. Okay. Also, I've taken note that accounts period for greater than 12 months, such that there is no account period ending in one tax year, the profit for that period is scaled upwards to equivalent of 24 months. Equivalent of 24 months period profit. The scaled up profit is then charged to income tax in the equal amounts in the tax year when no accounts were prepared, and in the tax year in which the accounts for the period were actually prepared. So that's what we look at. That is very important to consider. Okay. Further, just to sum up, the process of scaling up profits upwards results in overlap profits, as we have seen, and I've said that an overlap profit is that part of the profit subjected to income tax assessed more than once. Okay, that much you should do, remember. Okay, and then overlap profit can be rolled forward to be relieved against that final trading tax year of assessment. I've already mentioned that. Okay. And then the last point is, but not the least, if the final tax year profit is sufficient to absorb the overall profit, the balance is set off against the assessment of the penultimate tax year. So when you say penultimate tax year, we mean that the year which is second from the last. Okay, that's penultimate tax year. The relief under which the overlap profit is relieved is known as overlap relief. That's what I've state the points for you to consider. Okay. So let's look at another example to just complete. Let's look at another example to complete. So we are looking at, in this case, Jabulan. Okay, example number 3 has to do with Jabulan. Jabulan has been in business for many years, preparing accounts to 31st March. After preparing accounts for the financial year ended 31st March 2020, he changed the accounting date to 30 September and prepared the next accounts for the period of 18 months ended 30 September 2021. His tax adjusted profit for the relevant accounting period are as follows. So we have this. Okay. What tasks are we have here? Show the income tax assessment for tax years 2018, 2019, 2020, 2021, and 2022. Okay. Why are we starting from 2018? Just looking at this accounting date, you can see this one. The first one is 31st March 2019. 31st March means that it signals to us that we are supposed to use preceding year basis. Which tax year to 2019 is 2018. That's why we are starting with 2018 here. Okay. So all these, the first two are preceding year basis. Then there's the change of accounting period. So all the way from 1st April to 30 September 2021, you have 180,000. Okay. So if you count, you find that you have 9 plus, that is 18 months, if I'm not mistaken, 18 months, okay, where you earned 180,000. Then you have the normal period, which is 30 September 2020, which is 12 months, 89,000. Okay. So again, my approach is first of all to look at what are the key points that we need to look forward to under this particular example. So, points to note: Jablan prepared accounts to the date following between 1st January to 31st March, therefore is preceding year basis. After change of years, after charge year to 30 September, the basis of assessment changed to current year basis. Okay, you can see we started moving now, preparing accounts to 30 September. Okay, so it's changed. Okay, change to current year basis. The next point is in tax year 2019, the basis period is the period of the year ended 31st March 2020, from the year ended 31st March 2020, and for the year ended tax year 2020, for the basic period is 12 months ended 30 September 2020, which is the new accounting date. In the tax year 2019, the basic period is a period of the year ended 31st March 2020. Okay. However, the accounting date does not exist, hence the profits of 18 months are to 30 September 2021, which need to be expanded to 24 months and shared between the 2 years, 2020 and 2021. Okay, so that's what is the implication there. So what do we do in this particular case? So we look at the expansion. So just like before, if you look at cross multiplication, you are going to end up with this figure of 240,000. This 180 is for 18 months. What is for 24 months? You cross multiply, you end up going to have 240,000. Okay, so that's what we have here. Maybe let me underline this to make it more. Okay. Then we also have what we want to know as profit chargeable for the tax year. We also underline that. Okay. This is for going to cover for 2 periods, 12 months each. So you split this into 2 equal parts. So half of it for 2020 and the other half for 2021. So that's what is happening here. Okay, so that's what is going to happen here. So when you have scaled up the profit, you have to find the difference between the scaled up amount and the actual amount. The difference is going to be the overall profit. The overall profit in this case is 60,000. Okay, so that's what we have. That's what we have. That is the overlap profit. Okay, so let's move on to see how this plays out. So looking at what we have calculated now, we can schedule them in this particular manner. We have preceding year basis. Let me just look at that. Starting with 2018. So let's look at the original question. Okay, we have 31st March 2019, 65,000. So the basis period is not this one. Let me just correct this one. The basis period, this is 31st March 2019. 31st March 2019. 31st March 03 2019. That's what we have. Since the preceding year basis, the tax is 2018. Next one, again we have this one, which is the 1st March. Okay, the 1st March 2018. Okay, 2018. No, 2020. This is 2020. Look at this one. Okay, 2020. This one. Okay, that's what we're using. Is what we're going to see here. But there, since this is preceding year basis, we are going to be this will be assessed in the tax year 2019. That's the preceding year basis. That's the preceding year basis. Okay. Then the next one, it involves the split. Okay, it covered 2020 to all through to 2021. We scaled up the profit to 24-month period and split into two to be shared by the two accounting periods, because there was no accounting period in between. So we shared that too. So I mean that 2020 gets 120,000. Okay, and 2021 also gets 120,000. That's calculated above. Then the next one follows through smoothly. It is the current year basis now, which is 30 September. The current year basis, so 2022 of 89,000. So that's how it is computed. Okay, that's how it is computed. What lessons are we drawing from there? What lessons are we drawing from there? So what we have seen that where the first account period resulting from the change in the accounting date produces a loss, the loss is the final trading loss. Where the loss arises from a situation where any profits would have been scaled up, the loss is not scaled upwards. Okay, so those are important things to note. In case you have such a situation, that's how we're supposed to remember. Okay. We also move on to look at another example, being the last example. We have Sosala began trading on 1st January 2016. Okay, Sosala began trading on 1st January 2016. He prepared the first account for the first accounting period from that date to 31st March 2017. The tax adjusted profit before capital allowances were as follows. This is what is given here. Sosala had the following transaction in non-current assets. We have this. Okay. So, and then required calculate capital allowance for the relevant charge years in question, calculate the amounts of profits chargeable for each of the relevant charge years. Looking at this is what I'm going to look at in the next session on this particular one. To end up this one, I want you to start with a fresh mind so that you follow through. For now, I want you to concentrate on what we have covered in part 1 and part 2. And then in part 3, I'll deal with this example and then conclude this accounting dates and basis of assessment for tax purposes. So any question that is arising from this? Okay.
Yeah. I think we just need the notes so that we go through.
Okay, that's what I think
Yeah.
as well, so that you actually reflect on what I've covered. In case there are any queries that can arise, we can go back a bit and cover that, and before we look at this particular example. So I think for today, this presentation we end here. Thanks for listening. Please make sure that next we look at the next example. You are attentive and you have gone through the two parts, part 1 and part 2, so that you don't get confused. Thank you for listening.
You're welcome.